Bank of America, though, is warning that this market is flashing a sell signal because investors, they say, are going all in. According to their December Global Fund Manager survey, the cash levels in a typical portfolio have dropped to just 4%. That's the first underweight cash position in 7 years. Where's that cash going? Well, according to B of A, the most crowded trades right now are long tech, short the dollar, and long Bitcoin. So are my next guests in those trades and positions. Let's bring in Marco Papich. He's chief strategist at the Clock Tower Group. And Jeff Crumpleman is chief investment strategist with Mariner Wealth Advisors. It's good to have you guys here. Marco, first of all, are you positioned like, I guess, everybody else on the planet? And how much stock do you put into these surveys as a contrarian indicator?
Well, I think how I'm positioned is less relevant than how are the institutional investors that we speak to positioned. And I would say the one caveat on that view, which I think is overall correct, like there is euphoria clearly in the markets, is just that a lot of institutional investors, a lot of the real money out there, didn't really believe this rally from the beginning to now. And so the only caution I would throw to it is that a lot of cash is still on the sidelines in institutional sort of pools of capital, and they are definitely long tech, but there's this vicious rotation into cyclicals that is, first of all, occurring already and could have a lot more room to go. So is BOA correct to say that there's a sell signal in the near term, like tactically? Sure, maybe, but that could be actually this rotation into cyclicals and more value-driven assets.
And Jeff, we've seen that kind of play out since September. I mean, we had markets looking pretty extreme back then, and the kind of pullback that we got was one that really was more focused on big tech and some of those names, while the other trades like energy have been absolutely taking off. So how does your positioning stack up relative to the rest of this fund manager universe?
Well, whenever we look at the market, we look at three things. We look at the fundamentals, we look at valuation levels, and we look at technicals. And actually, I think all three line up pretty well for a nice cocktail or champagne kind of toast as we move into the year. Short term, we might be a little overbought. We talk about sentiment. So short term, we look a little overbought after a 65% run. But actually, if you look at the fundamentals and you see the pent-up demand and the way the economy and earnings have recovered and should continue to recover in sustained fashion after introduction of a vaccine, I think the fundamentals line up pretty well after we push through maybe a bit of a pause in Q1. Valuation at 20 times when you've got rates somewhere around, less than 1% on the 10-year, and then leadership in some of these higher beta areas that we see, it doesn't suggest that people are scared that we're going to run to defensives and that type of thing. So I think this has legs, albeit we could have a correction at any moment just because we're short-term overbought and there are a couple of wall worry items.
Shepard Smith here. Thanks for watching CNBC on YouTube.